A single corporate press release effectively vaporized $180 billion of global wealth. In an instant, 30,000 employees lost their livelihoods. Global pension funds were decimated. And the second largest telecommunications empire in the United States initiated what would become, at the time, the largest corporate bankruptcy in human history. This catastrophe was not triggered by a technological failure. It was not the result of a sudden shift in consumer behavior. It was an $11 billion fabrication hidden in plain sight, engineered entirely through basic arithmetic. How does a $175 billion titan vanish into the ether based on a lie so simple an undergraduate accounting student could understand it? Today, we open the books. To understand the magnitude of the collapse, we must first examine the baseline health of the patient. Before the infection took hold, WorldCom was an apex predator. The entity was guided by Bernie Ebbers, a former high school basketball coach and motel chain operator who possessed an insatiable appetite for corporate expansion. Starting in 1983 as a small Mississippi-based reseller of long-distance services called LDDS, the company utilized a strategy of relentless, aggressive acquisition. Throughout the 1990s, Ebbers acquired over 60 communication companies. His strategy was brutal and effective. Use WorldCom's constantly rising stock price as currency to buy competitors, absorb their revenue, and mask operational inefficiencies through sheer, blinding scale. The strategy reached its zenith in 1998 when WorldCom executed a $37 billion hostile takeover of MCI. At the time, it was the largest corporate merger in history. By 1999, the patient was operating at peak capacity. WorldCom was handling roughly 50% of all United States internet traffic and 50% of all global emails. On June 21, 1999, WorldCom stock peaked at $64.50 per share. The company's market capitalization swelled to an astonishing $175 billion. Wall Street analysts viewed Ebbers as an oracle, but hypergrowth is a volatile condition. It requires constant feeding. And when the external environment shifted, the patient's underlying vulnerabilities were exposed. Total systemic collapse is rarely the work of a single rogue agent. It is the product of a controlled environment where skepticism is treated as treason. Deep within the headquarters in Clinton, Mississippi, Bernie Ebbers didn't just lead a company, he demanded a congregation. This wasn't a culture of performance, it was a culture of absolute, unquestioning compliance. Ebbers was known to micromanage the smallest expenses, even the cost of flavored creamers in the break rooms, while simultaneously ignoring the massive multi-billion-dollar adjustments being made in the accounting department. This was the tone at the top. Internal whistleblowers later described an environment of fear. When lower-level accountants questioned the prepaid capacity entries, they weren't given explanations, they were given ultimatums. In the autopsy of a corporate collapse, we often find that the first organ to fail is ethics. The turn of the millennium brought a severe macroeconomic shift. The dot-com bubble burst. The telecommunications sector, anticipating infinite demand, had laid millions of miles of fiber optic cables. The result was a massive oversupply of network capacity. Prices collapsed, demand stagnated. WorldCom's revenue growth hit a wall. In the financial markets, stagnation is treated as a terminal illness. If WorldCom failed to meet Wall Street's quarterly earnings expectations, its stock price would plummet. For CEO Bernie Ebbers, this was an existential threat. He had leveraged hundreds of millions of dollars in personal loans using his WorldCom stock as collateral. If the stock fell, he would face financial ruin. Faced with declining revenues, the executive team, orchestrated primarily by Chief Financial Officer Scott Sullivan, made a deliberate choice. They would not report reality, they would engineer it. The mechanism of the fraud was breathtaking in its simplicity. It involved a fundamental manipulation of accounting principles regarding line costs. To provide global service, WorldCom had to lease the use of other telecom companies' networks to connect calls. These leasing fees were known as line costs, and they ran into the billions. Under standard accounting rules, line costs are operating expenses. They are the basic cost of doing business. When you pay them, they immediately reduce your profits for that quarter. To avoid reporting massive losses, Sullivan ordered his accounting department to reclassify billions of dollars in line costs from operating expenses to capital assets. Let us break this down into a real-world equivalent. Imagine you rent an apartment for $2,000 a month. This is a recurring expense that drains your bank account. Now imagine you simply cross out the word rent on your ledger and instead write property investment. You tell the bank that you are not losing $2,000 a month, but rather you are acquiring $2,000 in new real estate equity every 30 days. By categorizing everyday leasing expenses as long-term capital investments, WorldCom removed billions of dollars of expenses from their income statements. Overnight, a devastating quarterly loss was magically transformed into a robust Wall Street-pleasing profit. It was not a sophisticated financial instrument. It was a crude, brazen lie, but it worked. For nearly 2 years, from mid-2000 through the first quarter of 2002, WorldCom injected phantom profits into its bloodstream, hiding the necrosis spreading through its operations. A fraud of this magnitude requires complicity, silence, and blind trust. WorldCom's external auditor was Arthur Andersen, the same firm that had recently enabled the Enron disaster. They signed off on the books without question. But internal anomalies leave traces. The timeline of collapse begins not with regulators, but with a single, uncompromising employee, Cynthia Cooper, the Vice President of Internal Audit. In May of 2002, Cooper noticed irregularities regarding a capital expenditure account labeled prepaid capacity. When she asked executives for the supporting documentation for these entries, she was met with evasion, hostility, and direct orders to delay her audit. In corporate forensics, obstruction is the loudest alarm. By June 2002, the tension inside the internal audit department had reached a breaking point. Cynthia Cooper knew that if she was caught, her career was over. The CFO, Scott Sullivan, had explicitly ordered Cooper to stand down, but the numbers didn't align. Cooper and her team, Gene Morse and Glenn Smith, began a covert operation. They worked through the night, terrified that the company's internal security or IT department would track their access. They were looking for a specific software tool, a secret backdoor used by the accounting department to move hundreds of millions of dollars with a single keystroke. When they finally found the entries, they realized the fraud was far larger than they had imagined. It wasn't just a mistake, it was a systematic digital assassination of the company's integrity. Cooper and her small team began working in secret. Arriving at the office late at night to avoid detection, they bypassed normal IT protocols and directly accessed the company's core accounting databases. What they uncovered was not a mathematical error, it was a financial crater. They found $3.8 billion in fraudulent capital expenditure entries. The lifeblood of the company was entirely synthetic. The domino effect began immediately. Cooper took her findings directly to the board's audit committee. CFO Scott Sullivan was summoned. Cornered by the undeniable data, Sullivan attempted a final manipulation. He asked for the weekend to draft a white paper justifying the accounting treatment. He asked for more time. The committee refused. Sullivan was asked to resign. In a final display of hubris, he refused to step down, forcing the board to fire him. On June 25, 2002, the patient flatlined publicly. WorldCom announced to the world that it had inflated its profits by nearly $4 billion, a number that subsequent investigations would reveal actually exceeded $11 billion. The reaction was swift and merciless. The stock, once trading above $60, crashed to pennies. Less than a month later, on July 21, 2002, weighed down by $30 billion in debt and zero credibility, WorldCom filed for Chapter 11 bankruptcy. While the executives fought their legal battles in Mahogany Row courtrooms, the collateral damage was felt in the living rooms of ordinary Americans. 30,000 people lost their jobs. But the numbers don't tell the full story. Thousands of retirees had their entire life savings invested in WorldCom stock, a stock they were told was as safe as gold. When the stock hit zero, it wasn't just numbers on a screen, it was the loss of homes, the cancellation of college funds, the end of planned retirements. In the financial world, we call this market volatility. In the real world, it's a tragedy. This is the true cost of a corporate lie. The forensic analysis of WorldCom yields a chilling diagnosis. CFO Scott Sullivan pleaded guilty to securities fraud, turned state's evidence, and received a 5-year prison sentence. CEO Bernie Ebbers took the stand in his own defense. His strategy was to claim absolute ignorance. He argued that he was a visionary, not an accountant, and that he simply did not understand the complex ledgers his team prepared. The jury did not accept the defense of calculated incompetence. They determined that a CEO who micromanaged the cost of coffee in the break room could not be blind to an $11 billion discrepancy. Bernard Ebbers was found guilty of fraud, conspiracy, and filing false documents. He was sentenced to 25 years in federal prison. The ultimate cause of death for WorldCom was a malignant corporate culture. It was an environment where the preservation of the stock price superseded the preservation of reality. Driven by executive greed and a desperate need to appease Wall Street, the company engaged in a systemic, prolonged delusion. WorldCom stands as a permanent monument to the limits of financial manipulation. You can capitalize your expenses, you can leverage your assets, and you can lie to the auditors, but eventually the math catches up, and gravity always wins. The markets never forget, but they do forgive the next fraud. Subscribe to Financial Autopsy to see who falls next.